And our next guest says the Goldilocks conditions in the economy could actually lead to more volatility as markets react or maybe overreact to any perceived threat to that delicate balance. Joining us now to discuss is Lauren Goodwin, economist and chief market strategist at New York Life Investments. Why don't you dive in and explain a little bit more about what that introduction just characterized your viewpoint as being? And in other words, that we are a little bit spoiled, I guess, or a little bit on knife's edge, and that anything that is seen as adverse to the markets could create an outsized response.
Well, Bob's done an amazing job of laying out the reasons why investors are so confident right now, and that a consensus has emerged around a soft or even no landing in the economy. I think the question for investors then becomes, is that a no landing, or is it a reacceleration of economic activity? Because the market pricing we're seeing over the past couple of days really reflects more of a reaccelerating environment. I'm skeptical that that's likely to be the case. We have a very constructive outlook. It's very difficult with profit margins where they are to expect that we'll see much weaker labor market or economic conditions. However, historically, when the Fed has cut even into soft landings, we haven't seen profits reaccelerate or hiring reaccelerate. We've seen stability. And stability, it's good news for the economy, but it might mean more average equity market returns, average bond returns. That's an environment that after the last couple of years of knockout returns may not feel so good.
That was really where I was going to go with my next question, and that is that what you're saying leads me to believe that it is unlikely for the returns that we've seen over the last 2 years to repeat themselves.
I think that's the case, and it's not one that investors need be overly concerned about, but it is one that requires a pretty serious call to action for investors. If you have the Fed cutting interest rates even 25 or 50 basis points from here, it creates meaningful reinvestment risk for investors. And so we're looking to add interest rate or income generating capacity wherever we can. We really like short duration credit for this reason. And then in the equity markets, good profitability, it's a good place to be invested. We're not necessarily bearish on the semis or chips or part of the market that's performing very well, but we do see valuations as and market conditions as an opportunity to rebalance a bit. Some of the sectors that see structural investment, even related to AI, like energy, like utilities, these are sectors that benefit from slightly lower interest rates. And so we see an opportunity to broaden equity exposure in response to these market conditions.
When you look under the hood, and I agree with you in terms of where the market is, what other opportunities? You mentioned utilities, and maybe REITs in there as well. But are there other sectors that you think could benefit, especially now that we're going to a period where, hey, companies aren't really going to be raising prices? It's going to be much more about cash flow and probably cost cutting at this point as well.
Yeah, I agree with that perspective. And it's an environment then where we have to look pretty closely under the hood again at income generating opportunities, just as much or maybe even more so than valuation expansion opportunities. Dividend payers are one of the segments of the market that have been underloved over the last couple of years, but again, may benefit from this type of environment. And then if we look at the U.S. election and the type of sector benefits that we may see from just sustained capital investment from the government, from the private sector, we again see quality brown, low-cost green energy as benefiting from those investment trends, defense, and then infrastructure along the semiconductor supply chain. Again, these are parts of the market that are not only seeing that structural investment, but are also beneficiaries of modestly lower rates.